NIO stock has been climbing higher and higher over the past year, and while the company's Chinese name Weilai literally translates into English as blue sky coming, many have been wondering whether blue sky is at all in the forecast for the stock. With its price continuing to climb, a crash could be imminent, and here are 10 reasons why NIO stock is potentially a bubble. Electric vehicles are on the rise, and the electric vehicle industry has been exhibiting extremely high levels of irrational exuberance within the stock market over the past few years. The reason why people are buying electric vehicle stocks is pretty easy to understand, as most developed countries are currently focusing on trying to reduce their carbon footprint and plan to continue doing so in the future. This means electric vehicles have become the future for the audio industry, and it's really not a matter of if electric vehicles will take over the roads, but a matter of when they'll do so. As a consequence, auto stocks like Tesla and NIO have risen enormously, with shares of Tesla being up almost 590% since the beginning of 2020, while NIO has gained a whopping 1,240%. The Chinese electric vehicle company has similar ambitions to those of Tesla and are constantly compared to the US company, with investors hoping that NIO will one day become sort of like the Chinese version of Tesla. This is why the NIO stock has risen by so much, but for a fairly young startup company, it's pretty crazy valuation, and it comes with huge expectations for the stock of a company that isn't even profitable yet. Electric vehicle stocks can obviously be long-term winners for investors, but probably not before the bubble bursts on these insane valuations and we get back to reality. In early 2020, the NIO stock went down to about $2 a share, but then proceeded to skyrocket to over $50 a share, which translates to an increase of over 2,500%. NIO had a market capitalization of close to $70 billion, so naturally people started wondering whether this stock is a bubble and whether it would crash soon or whether it still had room to grow, especially over the long term. The question that arose was whether this is just another case of an overly hyped spec stock that's being pumped up by a lot of inexperienced investors and the broader market, and there are certainly things that definitely point towards the NIO stock being a huge bubble. If you compare NIO's market cap to that of big players in the automotive industry, you will see that their valuation is absolutely insane. General Motors, for example, has doubled its share price from its lows during the pandemic and is currently worth $59 billion, $11 billion less than NIO. This is crazy enough considering how big of a legacy GM is, but it gets even crazier. GM is thought to have done around $120 billion in business in 2020 and is expected to rebound in 2021 and make a profit, whereas NIO only made around $2 billion in revenue. And as mentioned before, the Chinese company isn't even profitable yet. Since NIO isn't profitable yet, the company's stock can only be valued based on sales, which puts them at a price-to-sales ratio of over 44. Now, usually a price-to-sales ratio of around 1 is considered a good value, so this is about 44 times larger than the typical threshold, which sounds almost too good to be true. It isn't unusual for young and high-growth companies to see much higher PS ratios, because they're expected to grow at a much higher rate than well-established companies. However, even a PS ratio of about 10 would be incredibly high for a company like this, and this is still 4 times that amount. Add to that the fact that in 2019, NIO lost more money than they brought in sales, and the fact that they weren't even profitable in 2020, a price-to-sales ratio this high is definitely not a good sign. We already mentioned that NIO's market cap is currently larger than that of GM. However, it is also larger than that of Ford, and even though Tesla's market cap is about 7 times larger, NIO stock is still more expensive than Tesla's. If you compare NIO's market cap to the revenue that they generate, the Chinese company's stock is actually about 2.5 times more expensive than even Tesla, over 83 times more expensive than GM, and 160 times more expensive than Ford. In 2019, NIO only brought in about $1 billion, while Tesla did over $28 billion, GM over $115 billion, and Ford over $130 billion, which is absolutely insane. On top of all that, all companies generate billions in operating cash flow, meaning the profit that they make from just running the normal business operations every day. With the exception of NIO, the Chinese electric vehicle company's cash flow was just negative by over $1 billion in 2019, which was still more than they brought in sales. So it seems like NIO stock is definitely overvalued, not only compared to the broader market, but especially compared to their peers. NIO isn't the only Chinese electric vehicle maker. It is closely followed by 2 others, XPeng, worth $29.3 billion, and Li Auto, worth $25.7 billion. These two companies together are now nearly equal to GM's market cap, which certainly makes you wonder. It seems that China's government were the ones who started it all when they decided to fund NIO with a $1 billion loan in early 2020. In addition to that, the company also has a big investor in Tencent Holdings, one of China's 3 cloud emperors with a market cap of $664 billion. And then there's the fact that many of NIO's cars are made by government-controlled GAC Motors. What it comes down to is that China was pretty embarrassed by Tesla's success in the country, especially when the American electric vehicle maker won the right to build a gigafactory in Shanghai. In early 2020, Tesla had over a fifth of the market until China decided to crush that, cutting them down to 10% market share in the country. More importantly, China is planning to take over the global electric vehicle market, and Li, XPeng, and NIO are the high-class car companies that it counts on for this endeavor. All 3 companies are also receiving capital from Western investors, but NIO is definitely leading the way. The Chinese electric vehicle company has also profited from buy ratings from brokers, as well as speculators taking up prices of $100 per share, which has convinced even some of the more experienced investors to contribute to even more air being pumped into what appears to be a giant bubble. There's no denying that Ford and GM have been declining for years because they have been very slow to adapt to a changing market, which has really hurt them. However, both companies are planning to invest big bucks in their own electric vehicles, which could mean more competition in the high-growth electric vehicle market. Ford is planning to invest over $11 billion through 2022 to build at least 16 electric vehicles, including the Mustang Mach-E crossover SUV, releasing this year, and an electric F-150 truck, releasing in 2022. GM is taking things even further, investing $27 billion through 2025 to release at least 30 new electric vehicles globally, with 20 planned for just North America alone, which also include popular brands like reviving the old Hummer into a brand new electric vehicle. Granted, none of the vehicles these two automakers plan to release will have the same type of autonomous driving technology that Tesla and even NIO do so well, and it is also unlikely that the larger trucks will play a major role in China, where the average electric vehicle is much smaller, but it just goes to show that the bigger car companies haven't given up on the electric vehicle market yet. Many of these giant players in the automotive industry are investing heavily into the EV market, which could mean that it will become a lot more crowded and a lot more competitive sooner than most people think. Plus, NIO also have plans to expand to Europe, where the company will face even more competition from companies that are several steps ahead of Ford and GM. The advantage that NIO currently have is that the company only operates in what is by far the largest EV market in the world, in China. However, even there, the competition is quickly getting fiercer, which could cut into NIO's future growth. As of September 2020, there was not a single NIO vehicle that made up the top 10 plug-in sales in China, with their NIO ES6 crossover SUV coming in just shy of that at number 11, though it had dropped down to number 20 by November. It was actually the Tesla Model 3 which was well established in the first place, until it was dethroned by the Wuling Hongguang Mini EV, which interestingly enough was built in partnership with General Motors. Of course, one has to keep in mind that some of the electric vehicles on this list are actually much cheaper and much smaller EVs with little range and no autonomous driving technology, so they can't really be compared to EVs like Tesla or NIO. But even so, the market could still become a lot more competitive in the future. In order to get a better idea of how NIO is really performing, you should really be looking at fully electric EV SUV sales, since that is basically all that NIO currently does. And if you then look at the numbers for China, you will actually find that NIO has been the #1 bestseller for over a year, which is pretty surprising. The company has done a great deal to stay relevant by practically releasing a new vehicle every year. First, their largest ES8, then the smaller and cheaper ES6 crossover, and most recently the smallest and cheapest EC6 crossover coupe that was released only a few months ago. All of them are already pretty successful, but NIO vehicles are pretty expensive, which could become an issue. Even Tesla has had to drop their prices several times in the past, probably to stay more competitive in the Chinese market, and they are getting ready to release a made-in-China Tesla Model Y, whose price could be pretty low on a competitive level. As mentioned, NIO have very high ambitions not just in China, but they also want to expand to Europe and then the States. They even have plans to do a robo-taxi partnership with Intel, and if all their plans work out, that could send the NIO stock even higher in the future. However, based on current numbers and on where the company is right now, it doesn't make sense for the stock price to be trading as high as it is. With NIO's market cap being larger than those of Ford and GM, who could still become huge players in the EV market, and with NIO's price to sales ratio being even higher than Tesla's, everything seems to point to the fact that expectations are too high for a company that is so young and is not even profitable yet. The risk-reward ratio just seems to be too heavy on the risk side at the moment, as investors are pricing the stock as if NIO is for sure going to be as large as Tesla in the future, which is obviously not guaranteed and perhaps not even very realistic. While it seems fairly obvious that NIO stock is in a pretty big bubble at the moment, it doesn't mean that this bubble necessarily needs to pop and that the stock needs to crash. The electric vehicle market will only grow to be a lot bigger in the future, and the fact that it will see a lot of growth bodes well for all companies producing EVs, especially those that focus solely on electric vehicles like NIO. However, at this point in time, their stock is highly speculative and has skyrocketed by so much over the past year that it just seems to be a little risky to buy at these levels, especially since this company still has a lot to prove.